Hello, I'm Natalie MacDonald bringing you this week's first Targets in Focus interview. Following a disappointing data week for New Zealand and an emergency rate cut from the RBA, Peter Dragicevich from Australia's Commonwealth Bank of Australia joins me on the phone now to discuss the Antipodean Currencies. Hi Peter. A hawkish RBNZ decision last week disappointed markets, sending the Aussie dollar Kiwi dollar plummeting to a monthly low. With business and consumer confidence out this week in both countries, alongside the RBNZ's suggestion of a rise in inflation over the 12-month period, what can we expect from the Aussie dollar, New Zealand dollar?
Well, historically, the Aussie-Kiwi cross has been very interest rate sensitive. So the moves we saw last week were a combination of the RBA cutting rates and also the RBNZ staying on hold. Now, interestingly, the RBNZ forecast, or its new forecast, continue to show that the next rate move in New Zealand will be a hike. That's in line with our thinking. But it appears that a lot of participants entered the meeting expecting the RBNZ to be slightly more dovish, so that did help support the New Zealand dollar towards the end of last week. But there's very little in terms of top-tier data out of New Zealand and or Australia this week, so we think that it will likely be offshore events that drive the cross rate. In that regard, we don't see too much, with the exception of the negotiations around the fiscal cliff and also the Fed meeting that will likely influence the cross rate. And overall, those events should offset one another. So we think the Aussie-Kiwi cross rate should consolidate somewhat this week and trade roughly around current levels.
The Aussie dollar had several challenges to face last week, including the RBA decision, Q3 GDP and November unemployment. Analysts have commented that Australia's domestic economy does not currently inspire great confidence. With this in mind, talk us through your predictions for the Aussie dollar against the US dollar.
Well, our forecasts have been for the Aussie dollar, US dollar to end the year at 105. We've had those forecasts in place since May of this year, and we're almost on track for that. We're just a few points off that at the moment. In terms of the Australian economy, I think a lot of negativity is played out in the media and by some analysts, but from a relative sense, the Australian economy continues to grow at around 3% per annum. We've got low inflation, which is in towards the middle of the RBA's target band. We're almost at full employment. So from a relative sense, we are still outperforming our global peers. So we can't make a case for the Aussie dollar to depreciate significantly against the US over the next few quarters or even into next year. Australian interest rates or yields continue to remain attractive. We're still AAA rated. The only major risk out there in the near term for our Aussie-US outlook is obviously the fiscal cliff. So our central assumption is that the fiscal cliff is avoided or watered down, and we're not likely to see a pickup in volatility. But you can never say never, particularly when things are in the hands of politicians.
There were hints of bullishness in last week's New Zealand dollar US dollar movements. It is generally considered quite a risk-sensitive pair. What role are the US fiscal cliff negotiations playing in the Kiwi dollar against the US dollar, and how does this factor into your predictions for the pair?
Well, our central assumption, as I previously mentioned, is for the fiscal cliff to be avoided, or the full impact of the fiscal cliff. We still expect the US to undergo some fiscal consolidation, but it will be more of an elongated program rather than severely front-loaded as it is in the current legislation. But in terms of the New Zealand dollar's recent movements and in regards to the fiscal cliff, we still haven't seen markets focus or react to the fiscal cliff. A lot of perception out there or expectation is for the fiscal cliff to be avoided. So at this current point in time, we haven't seen the Kiwi or the Aussie react significantly to any fiscal cliff headlines, given that underlying perception or expectation that the fiscal cliff will be avoided. But if concern does start to pick up over the next few weeks, we would expect both the Aussie and the Kiwi to come under some downward pressure given they are high beta currencies, and as that concern picks up, we would expect to see US equity markets and global equity markets take a leg lower.
As we near the end of 2012, what drivers, both domestic and global, will Antipodean currency traders need to watch out for as we enter 2013?
Well, obviously the main focus or main risk out there is the US fiscal cliff. There's now just over 2 weeks left until the new legislation comes into effect. Now, as we draw nearer to that, and if no resolution is reached, we would expect volatility to pick up and global equity markets to take a leg lower as people start to price in the increased chances of a US recession in the first half of next year. And typically that would increase expectations about a global recession in the first half, and that's why you'd see a repricing of asset markets. Now, in other risks out there would also include the US debt ceiling situation. Now, that was the main cause of the downturn in August of 2011, and that hasn't yet been resolved. So that's another risk event that's likely to weigh on investors' minds over the next few months. And also tying into that is the US, the potential for another round of US credit rating downgrades. In terms of the European situation, we've seen the political element rear its head again, given Mario Monti's views that he's likely to resign in the near term, given his loss of support in the Parliament. So that political element could reignite concerns about the outlook for the Eurozone economy as well. And I think they're the main issues and risks that we're watching for over the next few months.
That's all for now, but do stay tuned to Dukascopy TV for all of your latest FX updates. Bye for now.